It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. This is Managing Your Financial Future, and it is our podcast. Welcome back. Johnny Dean here with Professor Rick Plum, CFP. There you go. You're a certified financial planner professional.
Certifiable, yes.
Yes.
I am a certified financial planner, yes.
Professional. Yes.
I've been one for, 30
some odd years. For those of you new listeners, shouldn't have to do it too often, but yeah, you've been a certified financial planner professional, a CFP type.
I can't remember whether it was 90 or 91, but somewhere back in there is when I received my designation.
You got your designation. You were in the business before that. But that was right about the time, maybe shortly after when we started this, which was a radio show, went to a TV show, and then a podcast. I mean, we're just keeping up with the times. Anyway, time does fly. Tempus fugit, as they say. And this brings me to our topic, Professor Rick Plum, CFP.
Time?
Time is getting away from us.
Well,
which
yes.
means that 2022...
Oh, it's going quick, isn't it?
I was talking to somebody just this morning, and we were talking about long-term, the phrase long-term, where we talk about
Yes.
bucket 3 being a long-term investment, right?
Correct, yes.
And they said, well, what's long-term? I said, I want 15 years. And this person, she says, the older I get, 15 years does not seem like long-term. And I said, are you correct? 15 years ago was 2007. Now, that does not seem...
doesn't seem that... Wow.
No, I know. Is that something?
Yeah. And 15 years sounds like a long time, but it's a couple blinks and somebody was talking about 2023. We were talking about 2023.
Yeah.
I'm thinking, 2023 already?
Remember when
It's right around the corner.
Remember when 1984 was like the
The book.
the future, like that you didn't want to. Anyway,
Y2K.
What this means? Yeah, remember that? Wow, gee whiz. Talking about time, and it tends to get away from you, and the things that you want to do during the course of a year, especially the older you get, you lose track of it, and you say, I forgot to take care of certain things, and this is what I want to talk about.
Well, then I think about how fast the year has gone up until this point.
Yeah.
And the last couple months are going to go even faster because we get into the holidays, we get into everything that goes on, and
it's a blur.
Time just seems to accelerate.
Well, it does, because you're kind of on deadlines in during the holiday time. I mean, when November comes around, family starts to come in. You got holidays and all this stuff. I mean, it's gone before you know it. So there are some things that you need to take care of, at least from a financial standpoint.
Well, finance, long term is one thing, but finance still runs on year to year, especially taxes and things we have deadlines in finance that once you pass the deadline, it's a little too late to do anything about it.
Well, it's true, and people deal with this not just with the end of the year, but of course people know the tax deadline, which is, for most of the time, right around April 15th.
That's the tax deadline to file your return. Yeah. But the tax deadline to do anything about your return, to actually make a difference on what that return is going to look like, that's January 1 or December 31st, really. Because once you hit that date, all you're doing after that date is accounting for what happened. If you want to effect a change, you got to make that change prior to the end of the year.
Yeah, so let's go over a few of these things. And I've got a list of some. I don't know how many we'll cover. We'll see what happens. But one that stands out for a lot of people is required minimum distributions. Now, this affects people generally on the older side, which, of course, is yet another relative term.
Generally on the older side, but we've had a bunch of confusion about inherited required minimum distributions this year. And so, yes,
True.
For somebody, the typical required minimum distribution, and hopefully you've built this into your strategy, you've built into the fact that you're taking enough money just to meet your living expenses so you don't have to worry about a big infusion of taxable income at some point during this year. But the required minimum distribution is age 72 and older, and it doesn't matter what day you turn 72 during the year. Just the question is, will you turn 72 at some point in this year? If so, you have a required minimum distribution for this year. And it doesn't matter when you turn 72, when you can start taking money out and have it count towards it. Your birthday may be December 15th, but a January 2nd distribution in that year, you were barely 69 at that point. or 71 at that
71,
point. Old rules.
Yeah.
Barely 71 at that point, but that's still, it happened during the year that you turn 71. You don't have to wait until the day you turn 72 to have it count as a required minimum distribution. It is the year you turn 72, and any distribution during that year counts as a required minimum distribution. But you better start it. Now, your very first required minimum distribution, you can postpone. So if you are turning 72 this year, you have a required minimum distribution for 2022, but you can postpone that, the first one.
Only.
And only the first one until the first quarter of next year. So sometime during the first quarter up to April 1st of next year, you can take this year's required minimum distribution. So you can postpone, if you're turning 72, the 2022 required minimum distribution. But you can't postpone the 2023 when you're 73.
So you got two.
So you'll have to take both of them next year if you postpone the first one.
Now, I guess
go ahead.
There are reasons for doing that. Some people retire at the end of the year, and if they take it the following year in RMD when their income is lower, it may help them to some degree.
I've heard two rationales. One is that it gives you a chance to get into the swing of doing it. You may have forgotten the first year, you didn't know about it. The other one is that, yes, you may work through 70, the year, or 70, 72, and then it's better to take two in the following year than to tack it on top of your current, wages in the first year. So the rationale for why it works that way really doesn't matter.
Just
you got to do it.
You have to do it now.
For people that are still working, when you have different types of retirement plans, 401ks, 403bs, IRAs, and things of that nature, there is the ability to postpone your first required minimum distribution year from a company-sponsored retirement plan if you work for them that entire year, meaning you're still employed on December 31st. And so if I'm working for a company that has a 401k, I'm contributing to that 401k. Maybe I'm not even contributing to it, but I have a 401k with that current employer. I don't have a required minimum distribution from that current employer's plan until I retire. And that becomes my first year. And I can postpone that first one if I wanted to. But that doesn't apply to IRAs. IRAs are 72, and you can't defer it if you're working. You can continue to contribute now. Thanks to this.
That was fairly recent.
But you have a required minimum distribution. Yes, you're potentially contributing to it while you have a required minimum distribution, but that happens. Now we'll go back and say the deferment of a current employer plan assumes you are not the owner of the company. In fact, it assumes you don't own 5% or more of the company, because then you don't get the deferment. But otherwise, that's the required minimum distribution for the individual owner of the plan.
Now that if you have other 401ks from
previous
employers,
that deferment for current employment is current employment. I could have 3 or 4 401ks from previous employers, and if I'm not working for that employer, my required minimum distribution date is age 72 on those.
Yeah,
it's only the current employer.
Now, what if you miss your required minimum distribution?
Well, technically, there's up to a 50% penalty of whatever the shortfall is. If my required minimum distribution was 10 grand and I don't take it in time, potentially I have a $5,000 penalty. And I still have the money in the 401k I got to take out, or IRA that I got to take out and be taxed on at some point. So it's a fairly hefty penalty. So you don't want to do that. Now, if you've missed it and you've got a good reason, you can try to throw yourself on the mercy of the IRS. And actually, they're nicer than several state collection agencies.
States have a much more stringent collection policy because they actually use the money in their budget.
Right. But the other thing, what I've seen some people do is once they've realized they've missed it, they immediately take it out and they'll pay tax on it this year. Or it's up to you. Talk with your accountant and your advisor about what remedy is potentially available to you, but there may be some remedies to avoid that 50% federal penalty for missing a required minimum distribution. What I mentioned it earlier for inherited IRAs. I can't remember what act it was called anymore. Anyway, we got the ability. They changed
not the Secure Act. What was the other one?
Anyway, they changed the required minimum distribution rules for beneficiaries, for a class of beneficiary. If you are not a spouse, if you're not disabled, if you're not within 10 years of the age of the individual who passed away, basically you have a 10-year time horizon to take the money out of, and this was the Secure Act, 10 years to take the money out of your inherited retirement account.
So if Uncle Charlie dies and leaves me his $100,000 IRA
right.
as an inheritance, and I'm 58,
it doesn't matter your age. There's no penalty at this point for taking money out of the IRA, but it used to be that you could stretch it over your life expectancy. So if you had a 30-year life expectancy, you could take it out over the next 30 years, 130th, 129th, 128th, all the way down until 30 years is up. So you would look at, it was called the stretch IRA. We lost that for everybody basically except for spouses. And so we now have a 10-year time horizon to take the money out. And when the law first came out, it was for anybody who passed away in 2020 or later and who inherited an IRA in 2020 or later. Mm-hmm. It was basically, okay, well, we don't have to do anything for 9 years. And so it gave a lot of flexibility. We can do nothing and wait 10 years. We can take a little bit out each year. We can figure out what we wanted. We can tailor it. But there really wasn't any, great alarm yet because we had until the 10th year to take it all out. And in the 10th year, we had to have it all come out. Early this year, early 2022, the IRS came out with an interpretation that said, this doesn't fit with some rules that are on the books. One of the books said that an inherited IRA has to come out at least as fast as it was coming out for the owner of it. And they said, well, that doesn't work. So we're going to tell you that you have a required minimum distribution. If the owner of the IRA was that required minimum distribution age, and they've done some definitions here, so I'll skip that. You have a required minimum distribution. You can't wait 10 years.
Wow.
But they came out in 2022, and it affected anybody who died in 2020. So people that missed it in 2021 were like, well, now what do I do? Am I going to be faced with, because they told us last year we didn't have one. Now they're telling us we do have one. And so there was a comment period. And they still haven't put the finalized out, but they said, this is what the finalized is going to say. But just a couple of weeks ago, they came out and said, don't worry. For 2021 and 2022, if you are subjected to the new interpretation, which will be the regulations going forward, even though we haven't made them final yet, we're going to hold you to it starting in 2023.
Okay, so you're good till
there
next
will be
year.
No penalty, but this is only for people that were subject to the 10% or the 10-year rule.
How are you keeping track of all this stuff? I mean, I'm listening to you talk, and this is complicated stuff. I mean, exceptions to this rule. Somebody died then, you inherited then. How old are you? Are you less than 10 years, more than 10 years?
And I had this, somebody who passed away this year, who had heard about this new 10-year rule and the exemption from penalties this year. Yeah. And they said, well, does that mean that I don't have to take a required minimum distribution this year? Their dad had passed away this year. Their dad had not taken his required minimum distribution this year. When the person dies during the year, they still have that RMD for that year. And he said, well, I don't have to worry about it this year because they told us we don't have to worry about the required minimum distribution. That is true for the inheritee.
But not
the inheritee. Inheritor?
Yeah,
the inheritor
yes.
doesn't have a required minimum distribution until next year.
But the owner
still had one for this
yeah.
year. So it's only that subset. So it does get complicated, and it's why financial advisors can help.
If they know this stuff.
It's easy.
Oh, it is not easy. I mean, my goodness, I'm listening to this. This is the whole point of this particular segment of this episode of the podcast was to remind people to take their required minimum distributions.
Oh, yeah, do your required minimum distribution.
If you are taking your required minimum distribution and you have any type of like inherited IRA or anything like that, I think it behooves you to talk to an advisor.
Right. And if you have an inherited IRA, you cannot commingle it with your own IRAs. If you are 72 or older and you have an inherited IRA from somebody else, you have a required minimum distribution specific to that inherited IRA, and then you have your own accounts that you have an RMDs and specific to those accounts. These are things that you should be building into your strategy, so that you have control over these and you understand and you won't miss them.
Now, when you take money out of your 401k, 403, whatever it is, your IRAs,
yes.
that have a required minimum distribution, the idea is to take them out and you got to pay taxes on the money at whatever tax rate.
IRS doesn't care if you spend the money or what you do with the money.
No,
Congress just cares that you create a taxable event.
Right. Well, so you take the money out. When you take your required minimum distributions, the tax bill is technically something you're supposed to deal with the following April when you file your taxes. But would you suggest for people when they take their RMDs to withhold money from those required minimum distributions.
The tax bill isn't something you deal with. The tax accounting is something you deal with. You hopefully have paid in enough to avoid underpayment penalties through quarterly payments or withholding. And I would say that if you don't know what your tax bill is going to be, and you don't know whether that distribution from your IRA is creating a taxable event over and above what you're already paying, that you should find out. You should do some projections. You should find out whether or not that tax distribution is happening, and if you've paid in enough. Now, some people have already paid in enough through quarterly payments that they don't have to have any taxes withheld from their IRA, especially in the situation we're facing right now, where 2021 was a huge capital gain year and a huge tax year for a lot of people. And their accountants or their software set them up on estimated taxes based on last year's tax liability.
Yes, we talked about that with Jonathan Savona.
So they may be paying too much in taxes already, and there's no need to withhold any money on their taxes. But generally, I do like withholding money from the IRA distributions, assuming you understand what your tax liability is, so that you don't have to scrape up the cash next April when you file your return.
Well, exactly. Even if you're not required minimum distribution age, even if you're just over age 59 and a half, or you're taking money out, even if you're going to pay a penalty, I believe, I personally do, and I've done this with my wife's 403B, just withhold. We withhold federal and state. And then you're not necessarily getting too big a surprise, we hope.
Now, back in the 80s, the argument was, well, you don't want to give them too much money in withholding because look what you could earn in your bank account while you're holding on to it. And lately, we've gotten our bank accounts
coming back a little bit.
But 2% is still not enough to get past that, in my opinion, the aggravation of trying to find the money in April to pay a big tax bill.
It wasn't worth it for me back in the 80s, okay? So
yeah, but you only owed $10 back then.
This is true. All right, so one of the things, check your required minimum distributions, and then check your estimated taxes on those RMDs.
Right, I would say extend it from not just the RMDs, but check your estimated taxes for the year so you know whether you're under or over, and that way you can decide whether or not, if you are taking that RMD at the end of the year, whether you need to do any withholding on it or not.
When you say you're under or over, I think people are saying, well, wait a minute, what do you mean? Is there a minimum tax for everybody that we have to pay? What are you talking about? Are there penalties?
There's a minimum withholding for everybody.
Can you just go through that very quickly? Let's keep it simple.
You're talking about tax law here.
I know that, but let's withholding from your paycheck.
Withholding from your paycheck or quarterly payments. Withholding from your Social Security check. You can do that. Withholding from your pension. Withholding from your IRA distributions. You have a lot of flexibility on the withholding from IRA distributions. You can do nothing. You can do 100% if you wanted to. So the IRA is the most flexible. But the question is, will I owe taxes? And why can't I just not pay anything all through the year and then pay it in April when I file my return?
Right. So forget withholding. I'll just keep it myself.
I'll just pay it in April. Congress doesn't like that either for multiple reasons. I won't get into why, but they want you to pay it prospectively as your income is coming in. And so they've put up there is an under withholding penalty. If you owe taxes and you have not put in enough money through withholding or under or estimated taxes, you'll pay a penalty. And for the last several years, the penalty hasn't been very much because interest rates have been fairly low. But now interest rates are coming back up, and so the penalties and the interest that gets charged on it will come back up as well. But basically, you need to do one of two things. You either need to pay in at least 90% of what you owe for this year.
So if I have are you talking about what I owe, my total tax that appears online?
I don't know
whatever it is on
1040. Yeah, my total tax, and that includes all the different types of taxes that you pay on your federal return. I need to pay it. So if my total tax is $10,000, I need to have paid in through withholding or estimated payments at least $9,000 to avoid penalties. Now, if I've paid in $9,000, I still owe $1,000, but there's no penalties. I'll still pay the $1,000 when I file my return. So I have to put in either 90% of this year's tax liability, but what if I don't know this year's tax liability? I don't even know what my income looked like through the year. And say, then you can base it on last year's. It's either 90% of this year's or 100% of last year's tax liability. And it can go on whichever one is lower. And so if I know what my tax bill was last year, I have my return from last year. If I didn't owe any taxes at all, now when I say don't owe any taxes, that's not what you did or did not pay in April. It's what was your total tax that you owed last year. As long as I paid 100% of last year, doesn't matter. I mean, I've met my what they call safe harbor. But now, as we talked about before, I may not want to base it on 100% of last year because last year was a big tax year for capital gains. And I may have had a big tax bill last year and I don't want to pay that much. Now, if I pay that much, I'll just get a big refund this year. But
yeah, but again, you have to. Yeah.
So you want to know where you are on the withholding just to make sure that you don't hit a penalty, that you pay in the right amount, you don't get any big surprises.
Is this what you do for people too?
We try very much, yeah, especially for retirees. We try to get them close to. Now, I don't do their taxes. And we don't do taxes.
But you can project.
We can project a ballpark where they're going to be to make sure that they're within the safe harbor limits and make sure that they don't get any.
So it's part of the financial planning process.
Yes.
And again, these can all be some hidden penalties you didn't know about. I mean, what do most people know about taxes? They give the numbers to their tax accountant. Their tax accountant puts it together, and they pay whatever the accountant says they owe.
Right. I mean, I've heard people say, well, I don't pay taxes. I get a refund. Well, that doesn't mean you didn't pay any taxes. Yeah. It just meant you got back some of the money you already sent them.
You paid too much.
Yeah, you paid in a little too much.
You paid more than you owed. All right. So, my goodness. Wow. Our heads are swimming. And
we're on number 3.
Well, let's there are a few more things you should take care of before the end of the year.
Yes.
Now, RMDs are complicated because there's so many different.
There's a lot of moving parts.
There really are. So we can talk about qualified charitable distributions, which we mentioned before. These are QCDs. Now,
qualified charitable distributions.
Explain how this works.
When we get into our 70s and above, a lot of times we don't have the deductions, the mortgage payments and things of that nature to itemize. And so charitable contributions are no longer deductible to us because we just take the standard deduction anyway. So one of the nice things that Congress has done for us, over the past couple of years is they gave us this thing called a qualified charitable distribution where we can have money sent directly from our IRA to a qualified charity. And as long as we account for it correctly on our tax return, it's not a taxable event. And it counts towards the required minimum distribution. Now, it doesn't have to be exactly the amount of the required minimum distribution. It could be less and it can be more. You can do anywhere from $0 to $100,000 of a distribution directly to a charity and have it count as a qualified charitable distribution as long as you are at least age 70 and a half or older. And this is not the year you turn 70 and a half. This is the day you turn 70 and a half.
You have to actually be 70.
You have to be 70 and a half. And they have not coordinated this. It used to be coordinated with RMDs. Kind of coordinated. But now it is 70 and a half for QCDs, 72 for RMDs. But it helps a lot. And so if you are a retiree that doesn't need your required minimum distribution, which there are quite a few people that the RMD is a tax headache.
In other words, they don't need it to spend. They've
got pensions and other incomes that they don't need to take this money out so much. And they're charitably inclined. A QCD can work wonderfully.
So I want to give $1,000
to the zoo, to the charity,
whatever, some charity, and I want to use the money that's in my IRA.
Right.
I can direct the IRA custodian to send that whatever I want to send.
Whatever the dollar amount is, up to $100,000.
I can direct the
check made payable directly to that charity.
It doesn't go anywhere on my tax return.
Well, it doesn't go in the taxable column of your tax return. But you do have to be careful with this because there is no code on the 1099 for the QCD. Right. You have to make sure that you tell your tax preparer that you did it. Otherwise, they will put it as a taxable event. I don't know if that was Machiavellian on Congress's part or what, but you have to understand how to account for it. Make sure you're telling your tax preparer that you did a QCD if you did one.
Yeah, QCDs are actually very cool.
I
honestly think that if you're over age 70 and a half and you're charitably inclined and you have IRAs that you don't need them, money, where RMDs are just a hassle, heck, why not? You can't be hurt by doing it.
Yeah, even if it's not a hassle, it's part of your spending, but that's part of your budget.
Yeah.
And you could have that not show up, and that not showing up on the taxable column could make it less taxing on your Social Security. It could make other things
There are reasons
helpful.
for doing it, and we've done other shows on that.
Yeah.
Okay, so let's talk about a couple more things here before we run out of time. Tax. Here we go again.
This is going to get a little... Well, most of the year-end items are going to be revolving around taxes.
Okay, well, this is, and you're trying to save money on your taxes before the clock strikes midnight, December 31st.
And 2022 has been a lemon. I mean, we can be honest. It has not been a great year for investing.
No, you may have some losses.
So let's make some lemonade.
So what we do is we talk about tax loss harvesting. Now, I don't want to get too complicated in this, but explain, if you would, the general idea, Professor Plum.
Well,
which can be this could be a very good year for this, potentially.
It's probably a very good year because most people, especially if they've invested anywhere in the last 12 months or so, what they put into the investment originally has gone down in value. And so we're talking about personal accounts here, obviously not IRAs or tax deferred accounts. But if I put $10,000 into a mutual fund, last October, it may be only worth $8,000 right now. And what I can do is I could sell that mutual fund. Mm-hmm. And now I have a $2,000 loss. Now it's what they call a realized loss when I sell it. Up until the point where I actually sell it, it's an unrealized loss. It's a paper loss. But when I actually sell that investment in my hypothetical 10,000 purchase, 8,000 value, I open the door now. I have a realized, it's real. It's not a paper loss. It's real loss.
You sold it.
I sold it. I no longer have that investment. I can use that $2,000 of losses to offset other incomes. I can use it first to offset gains. If I don't have any gains,
capital gains,
short-term or long-term. If I have short-term losses, I use them first to offset short-term gains. If I don't have any short-term gains, then I can use them to offset short-term or long-term gains. If I don't have any long-term gains, now I've got a loss and no gains. I can use up to $3,000 of losses to offset other income on my tax return. Now, if I have $100,000 of losses, I can't use it all in 1 year if I don't have gains. I can only use $3,000 a year.
Man, when was the last time we've talked about this before? I said, who would have $100,000 of losses? When was the last time we talked about that? Well,
2000.
It's been a while. 2008?
Well, yeah.
I mean,
we saw big losses in 2000, 2001, 2002.
.com crash and all that.
Yeah, the .com bust. 2008, we saw losses.
Yeah.
But yeah, so you can carry them forward. So if I somehow have $100,000 in losses because I picked a real loser, I use $3,000 this year, and then I start next year with a $97,000 loss going forward. If I can't create any gains, then I use $3 next year, 94 going forward, and just I whittle away at it.
$3,000.
It's been that way since the 70s, I think.
They won't raise it.
They haven't yet, so we'll see. But yeah, understanding now. You also want to look, if you were an investor, especially in a mutual fund towards the end of last year or sometime this year, and you have a lost position, we're coming into the capital gain distribution season. And so you may want to look at your mutual funds. They're making the announcements. They're making estimates right now, and they'll be making finalized announcements of what the gain will be that they're going to distribute to shareholders that will be taxable to shareholders. And losing money stinks. Having to pay taxes after losing money on a mutual fund that issued a gain
is worse.
That's salt on the wound.
That's awful.
But you can sell that mutual fund, buy a similar one, just not the same one. Mm-hmm. And so you stay exposed to the market the same way and use that loss instead of getting the taxable event. Again, talk to your advisor about how this works.
Yeah, I was just going to say, please talk to your advisor about this because there are many ways that this could go wrong. I would say talk to your self-serving, but talk to your advisor on all this stuff. Because you don't want to do it wrong, but it can help you if you do it correctly.
Right, and now's the time to do it before the last second of the year.
One last thing now you can do, maybe by yourself. I mean, this has nothing to do with taxes, but before the end of the year, your 401k contributions, right? Maybe check to see have you made all the contributions you can make for this year.
Be all you can be with your 401k and 403b contributions, 457s. Yes, we have the ability in 2022 to contribute $20,500 to a 401k. And if you're aged 50 or more, you can...
Which used to seem so old.
Yeah, now it seems so young. You can do an extra $6,500 on top of that. Yeah. So a total of $27,000 if you're 50 or more, $20,500 if you're under 50. And if you aren't putting in that amount and you feel like you're falling behind, you want to do some catch up, you may be able to increase that 401k contribution to get as much in this year as you can. Next year, 2023, the limits are going up quite sizably.
Quite a bit. And I guess it has to do with interest rates and inflation or whatever.
It has to do with CPI. Mm-hmm. So we're going from $20,500 to $22,500 for everybody. Mm-hmm. And then from $6,500 to $7,500 for the 50 and older crowds. So it's going up a total of $3,000 overall. Now, sometimes we can only change our contributions on a quarterly basis. I know the plan we belong to, it's only quarterly.
So some companies only let you
increase
your
401k allotment.
contribution once per quarter.
Once per quarter, some are once per semi-annual, some are anytime you want. So it depends on the flexibility of your plan.
Yeah.
But if you can't do it for this year, you probably want to start next year off and increase it for next year.
Yeah.
But even if you're not at the limits, $30,000, $27,000 for 50 and older is still quite a big number for most people. If you feel that you want to increase, now's a good time to start increasing it. Put it in so that it increases. And if you have an automatic escalator option at work, put that on too, so that it automatically increases by 1% or 2% every year. And so you want to start pushing those a little bit harder. You want to start investing a little bit more. Now is a great time to be an accumulator of assets for the future. Now is a great time to be investing if you don't need the money for 10 or 15 years. Yeah. And if you're putting it into a retirement account, most likely you're not going to touch it for 10 or 15 years. Now is not a time to shy away from investing into the market. Now is the time that you want to be accumulating assets.
There's a sale on stock.
Yes. And so you want to you want to build up as many shares at these lower prices. Yeah, they could go lower and build up even more shares at that lower price.
Does this give credence to the, investors often tend to hate cash because it doesn't do anything.
Right.
It sits there. It's funds it's rainy day stuff, and it's not exciting. It's not sexy. But, the person who doesn't have the surplus cash to take advantage of downtimes, I think is at a disadvantage.
Well, and it depends on what, you are. I mean, having cash to be able to move into things, whether it be opportunities outside of the market, or opportunities inside the market. But the question is, where do you get the cash? And especially if you're on the younger side, 20, 30, even 40s for that matter, having a lot of cash on the sidelines probably isn't doing you any good because market timing isn't going to work in your favor. But, you want to be invested. Yeah. You want to be, especially if you have that time horizon. When you start getting 10 years out, 5 years out from retirement, even in retirement, that matter, you now have an allocation. How much money you can afford, or I should say, you should know how much money you can afford to have in the market that's subject to the ups and downs that the market gives us. We have no control over the market. We only can control how we react to what the market does. But in the years where the market's up 30%, like in 2021, those are years where we can take some of that excess return. We didn't expect it to be up 30%, maybe 10%. Let's take some of that excess return and put it into cash. Because at some point, it's going to come back down. And now you have the cash built up to buy into the market. That is a very systematic, non-emotional, rational way to do it. But that's not human. We're still human. And it's very hard when the markets are going up to sell off the cream.
Emotion will override intelligence.
And it's very hard.
I read this. Emotion will override any level of intelligence.
And you can have cash on the sidelines right now and say, I'm not buying into this market. It could go down more. True, it could. I don't know. But it's still a better time to invest than it was a year ago.
Here's something else I read. Every past downturn looks like an opportunity. Every current and future downturn looks like a liability.
Yeah.
Is that,
hindsight's 20/20 from that standpoint.
Well, that's just it. So you got to look at these things and say, hey, this is an opportunity, because when this is over, whenever it is, you're going to look back and say, why didn't I get in? Just a thought. That's all it is. Nothing to think about before the end of 2022. This was complicated. There's no other way to put this. Things you need to take care of before the end of the year. We mentioned required minimum distributions.
One last one.
Okay. Oh, you got one?
Roth conversions.
Okay. We should have mentioned that before, but yeah.
Markets are down.
Yeah.
It may be a good time. Now, I'm not saying they can't go down further, but now may be a good time to convert some of those assets so that they recover over on the Roth side rather than the traditional side. You got to know how much you're going to pay in taxes. You got to know where those taxes are going to come from, because it's not going to come from the conversion. You've got to know whether it makes sense in your situation to do it, whether you're triggering some other kind of tax if you take more money out. But you've only got until December 31st to do a conversion for 2022. And then After that, it's a 2023 and later conversion.
And we don't know what's going to happen in
So
2023.
now may be a good time to really look at that conversion issue.
Talk about all this stuff when we say Roth conversions. We talk about required minimum distributions, estimated taxes, QCDs, tax loss harvesting, 401k contributions even potentially. Talk to your advisor about this. I honestly, as you're talking about this stuff, and we're out of time here, but as you're talking about this, the complicated nature of this that I mentioned earlier really is hitting home for me.
Okay, well, it's fun.
Well, it's fun, but you need somebody who thinks it's fun to take a look at it for you.
You need a nerd, is what you're saying?
Well, pretty much. I mean, honestly, this is, I'm gonna have my medical stuff looked at by somebody who enjoys looking at medical stuff, and so my financial position needs to be looked at by somebody who understands it and who likes it and can find ways to perhaps potentially make it better for me. So
that's the goal.
Talk to your advisor. Professor Rick Plum is one. Professor Rick Plum is a CFP, and the folks at Lucia Capital Group are here to help you out. All of this was, part of telling you that when you have your advisor help you out, they should know what they're doing. If you talk to the folks at Lucia Capital Group, you guys do this all the time. I mean, every year
day.
we talk about this every day. You end of the year stuff. This is kind of the things that you go over for your clients, right?
Yes, and we've been talking about, as advisors, we've been talking amongst ourselves with the Lucia Capital Group of what's coming up, how to look at it.
Yeah.
And so it's not just one person. Everybody in this firm is looking into what are the things that we should be looking for? What are clients looking at? What are they seeing? And what's good for them?
800-644-1150, the number at Lucia Capital Group, 800-644-1150. Check out the website, too, luciacap.com, LUCIACAP.com. You can find all a bunch of videos. I mentioned QCDs. We have at least a couple of videos on there, and articles and blog posts. You can check those out. Learn some stuff. It's helpful. Knowledge, of course, is a big, powerful tool. luciacap.com. You want to subscribe to our podcast? Please do. Go to Spotify, and you can download the podcast, have it automatically download, subscribe, and listen every single week. And speaking of every single week, we got another week coming up next time.
Yes, sir.
All right. I'm going to have you back?
Yes.
Okay, good. For Professor Rick Plum, CFP, I'm your podcast host, Johnny Dean. Thanks so much for listening. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material contains tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in the loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum and Jonathan Savona are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.